In terms of value, where is value in this market?
I think according to us, the current value is in investment stocks. Current value is in investing with good companies with good quality promoters, but taking a 3-year view where the stocks are trading at book value, below book value. So I think if you really have guts in this market, I think mid caps are the ones you would go, but you will have to have a 3-year view, and you will have to have strong stomach, because I think the next 5-6 months we will see high volatility in the market. It might not go anywhere, but I think you can use the volatility to advantage, because stocks are I think individual stocks are reasonably cheap, and they've got it cheaper all through this year. So it could be a good investment year for stock picking.
Let me blend 3 points into one. How are you investing your personal money, your son's money, and your wife's money this year?
I think a large part is always in equities. Large part is in equities. I also found that investing through mutual funds is always a great one. So for my kids, we have SIPs, so that every month, investments goes into that, good markets, bad markets, and all. And as I said, I think there are good funds available which are giving you some good returns, and the fund management cost is fairly low. So I would say mutual funds. And I think outside of that, we would advise everybody that you should own a house. You should invest in real estate, at least for ownership and usage purposes. And I think out of that, for your liquidity requirements, you can buy some bonds. I think SBI bonds have very good yield right now, and they are fairly liquid in the market. So I think AAA bonds for your short-term needs and all will also give you a good opportunity.
Is there a sunrise sector at Edelweiss you are betting on?
I would think financial services as a whole is still sunrise, so it keeps on setting rather than rising in the last 3 years. But I would think financial services is going to be still has a lot of opportunities. I think consumption is still very good. I think the opportunity is in a lot of sectors in India. What is the problem is the execution cost, the competition, and all of that, because of the absence of scale. So I would strongly recommend going after industries which have scale, which have growth. I do think financial services will grow at about 25% a year for the next 8-10 years. Now, which parts of that, NBFC, capital markets, banks, insurance, they may have their own individual cycles. But on the whole, financial services I still see as a great investment opportunity.
How do you see FY13 moving for Edelweiss? You have 4 businesses, 20% is what you get from every business. For FY13, which business will contribute the most, and which business will contribute the least?
I think for us, NBFC, we are hoping it should be a good year, because interest rates have come down, because in the last couple of years, as interest rates had gone up, obviously your NIMs get squeezed, because you can't pass on all the cost to your consumers. So I think as interest rates come down for our credit businesses, it should be hopefully a good year from NIM expansion point of view, and I think credit offtake is also going to improve.
Over the years I've known you've always been a realistic person, but right now you're sounding optimistic and bullish to me. Why is that?
I hope I'm not overly optimistic, but I think the good thing about India is India comes back. I think when India is always completely down and out, we have had last almost 3 years of gloom, doom, and this cycle has been against us. I think the interest rate cycle, so a hike over 18 months that we saw has actually really innovated the economy. Plus obviously the government actions and the policy paralysis and all that has not helped the charm of India. But I've always seen that India comes back, India bounces back. There is always cycle in everything in life. And I think a country like India, with the kind of demographics we have and the savings rate, we still have a 32-33% savings rate. We are almost a $2 trillion economy, which means on $2 trillion economy, our savings are close to $600 billion in this year. So it's a large pool of savings which will go into investments. Consumption will be more than $1.4 trillion. You can't keep this economy down. I mean, no matter how much the government tries or anybody else tries. And also expectations. I think currently expectations are very low. Everything has been priced in. So I think every gloom doom scenario about India has started to get priced in. And as I said, on the other side, the interest rate cycle is at least giving some relief. I think rupee has been stable. So if I take all of this, the glass should be half full now rather than half empty. But again, in India will always be a challenging environment for the next few years, because the challenges in India are very high, given the the poverty we have and the kind of democratic processes we have. India will always be 3 steps forward, 2 steps backward. But I always believe that India gives you such a big opportunity. It also gives you quite a few challenges, because if it gave only opportunity and no challenges, then it would be easy for anybody to build a business and make profits in India.
This is different, Rashesh Shah. A year ago when I interacted with you, you were slightly worried, confused, and you were not ready to commit. Now you're sticking your neck out and you're confident that this year equities will make money.
See, because as I said, a year ago, expectations were very high. We could see, if you see the slowdown really started from October 2010 onwards. So I think by March 2011, it was fairly clear that the cycle had started. And Nikunj, what happens is everybody assumes the cycle will play out very soon. But these cycles, the industrial cycle, the interest rate cycles, are not 3-month cycles. They are 2-year cycles. So if you see that, I think we have played out almost an 18-month cycle. And as I said, until October, we are not seeing a huge uptick. So I think another 4-5 months, we will have a 2-year down cycle for India. So everything has got played out. Everything has got, it bottomed out. Expectations are low. Everything has got priced in. And we have seen a very brutal market, volumes low, confidence low, optimism low, all of that. So here is, I think you can only have positive upside. And along with that, fundamentally, as I said, a lot of things, the parameters are improving. They have not come back with a bang, but at least the uptick has happened. I think growth has bottomed out, it's starting to crawl in a very slow way up. I think we are fairly confident that oil price will not go up. In fact, oil prices might come down. Gold imports will be down, so the pressure on rupee is fallen a lot because gold imports are down. FII flows are fairly robust. Given all that, there are, the patient has not, it was in ICU, the patient was in ICU, has started recovering, so a lot of parameters are showing signs of recovery. Maybe it will take another 5-6 months to come out, and become strong again. But I don't think there is room for that excessive gloom doom that was there about 3-4 months ago. But also there is not room for euphoria and optimism. I think, as I said, India challenges are fairly big. I don't think we expect growth rate to be more than 7%. Inflation will be about 7%. But I think inflation at 7 and growth rate at 7 is actually better than inflation at 8.5, 9 and growth at 7.
So let me ask this question to investor Rashesh Shah. Where are you ready to allocate disproportionate amount of money, and what is your big call for, not asset call, but big sector call for FY13, which when you will look back, you want to proudly remember that call?
I think I would say, again, I don't think there are any sectors as such, because we are seeing a lot of specific companies which are...
Where are you picking up your spots? I'm curious to understand that. And I respect your compliance when it comes to a stock name.
No, I think more than that, Nikunj, it's about individual companies. There are a lot of companies which are trading fairly cheap. They're trading at book value. They will still grow at maybe 14-15%, 18-20%. Their interest cost has gone up a lot because a lot of these companies are in the mid-cap segment. So I think across the consumption we already spoken about, but I think we are fairly okay on telecom also. I think telecom will make a comeback this year. I think agrochemicals and the entire agriculture related segment, I think it looks fairly bullish. I think some of the construction companies will come back, what we're seeing recently in IVRCL and all that, because there is underlying value. See, I think the great will be companies which are asset rich and liquidity poor, with strong committed managements, which are either liquidating assets or earning out of the assets. And if you can stock pick this, it will be a great year for those.
So that's the punchline I wanted from you. Asset rich and then liquidity poor. Gordon Gekko once famously said that every man on Wall Street has a number. Do you have a number in your mind for FY13?
It's hard to pick. As I said, the first half we are seeing a sideways market. But as I said, I think the only thing we can say about FY13 is it won't be FY12.
And for marathoner Rashesh Shah, the target is 20 this year or 40 this year?
I'm trying to do a full marathon in October for Amsterdam, but I'm hoping...
So the number is moving.
It has to keep on moving in everything in life, Nikunj.
Good luck for FY13. Thank you for joining us. Glad you could accommodate this interview request.
Thanks, Nikunj. Enjoyed.
That's it on this edition of Market Makers. I'm Nikunj Dalmia signing off. Thank you for watching the show.